Hi, and welcome to Visual Sectors. In this video, we'll talk about reverse repo, how it works, what it means for the market, and exactly how you can benefit from it. $2 trillion on the sidelines is a massive factor, so make sure you are fully aware of the impact and risk for your portfolio. Let's dive in. Visual Sectors is a London-based investment data provider. Our data sets predicted the December 2021 high and the June 2022 low. Every day we process millions of data strings to provide you with simple and clear insights. Please subscribe, like, and share this video if you find it helpful. The RRP facility was introduced by the Fed to help banks earn interest on the extra cash they hold, but more importantly, to clear the extra cash off the overinflated markets. In 2020, with all the helicopter money coming in, banks found themselves sitting on a pile of cash coming from deposits. They didn't want to be overinvested in bonds or stocks, so hey, just kept the cash. Well, this cash reached more than $1 trillion in a matter of months. So the Fed said, we can hold your cash overnight and pay a small interest on it. So easy as that, banks transfer cash to the Fed at the end of every day and get it back with a small fee the next morning. But that fee is extremely small. Now, on this chart, you can see how the 0.05% RRP interest rate compares to the Treasury and major banks' bond yield. Now, back in 2020, federal 10-year bonds had a return of 0.5%, and Citigroup's bonds maturing in 2025 had 1.4% yield. Now, at the peak in 2022, the yields jumped to 4.2% and 5.8% respectively. Now, this spread is now massive, but more importantly, the cash in banks' assets is destroyed by money devaluation. So this means that with the reverse repo in place, banks are missing out on extra profits of around 4 to 6% of the RRP size per annum. Now, if they had invested that cash in government or market bonds, they could increase their profits significantly. Now, let this settle in. The banks could be making an extra $100 billion in profits every year. Well, can the bond market absorb this much money? Oh, yes, it can. The U.S. bond market size is as big as $46 trillion, while the global market is $119 trillion, and the high-rating bonds are around $5 trillion. So the RRP could easily flow to the bond market, causing only a temporary price hike in the investment-grade bonds. Moreover, 2023 and 2024 will bring the maturity of bonds for a combined amount of almost $600 billion. So 30% of the repo facility could just be replacing the maturing debt, not even inflating bond prices at all. And of course, there are other markets, stocks worth $40 trillion, real estate worth $60 trillion of total value, and so on. Well, how about inflation and consumer prices then? This is where we have to talk about the money base and the M2 money aggregate. It's actually pretty simple. M2 is the circulating money, including deposits, stocks, checks, etc. Money base includes everything in possession of the Federal Reserve, coins, cash, and reverse repos. Now, if we look at the CPI chart and the M2 charts, here we can see that they follow each other closely. The more money circulating, the higher the prices. Seems obvious, doesn't it? Well, during 2020 and 2022, the M2 aggregate indicator showed an increase of $3.5 trillion, or almost 20% of the available money. This led to an extra 5% in CPI readings and extreme stock market growth. If the RRP gets back to M2, it'll reach $23 trillion. And this will most likely get us to another CPI spike. If the proportions are kept, CPI may reach at least 9% and stay above 6 to 7% for several years. Now, the Fed will have to react then, but the boost in asset prices can bring amazing wealth to those who understand what's going on. So, how do we benefit from all this extremely complicated data? Let's make it simple. Every day, the Federal Bank of New York publishes the results of reverse repo operations. Follow this data, and as soon as you start noticing consistent decline, be ready to do one of the following, or both. Buy the bond ETFs like TLT, or even low investment grade bonds ETF and HYG, and buy solid banks with a great price to book ratio, Citi being my personal favorite. Now, these types of banks are currently valued at half the equity they own and also pay dividends, and their price to earning ratios are low. And let us remind you, the banks will get an extra $100 billion in profits when they allocate those $2 trillion, an extra 20% to their current profits out of thin air. You want to double a position? Buy a solid U.S. bank. Now, the key takeaways. Number one, reverse repo is an operation when banks park their extra cash at the Fed's accounts. Number two, the interest yield the banks are getting is next to nothing. They could earn an extra $100 billion if they invested in government bonds. Number three, the bond market can easily absorb all the RRP funds. The maturing debt of the next is worth 30% of the whole RRP. Number four, but this amount of cash will cause another CPI spike, maybe even send it all the way to 10%. And number five, follow the New York Fed RRP reports. When you see the money flowing in, buy Citi and TLT. This research was provided by visualsectors.com, and there is plenty more to come. Make sure you subscribe, hit the notification button, and share this video with all your friends. Visual Sectors is developing exclusive new data sets, providing unprecedented win rate. Please check out our Money Flows data set showing the direction of markets, sectors, and all optional stocks.